Hi, once again, welcome to the Big Picture Retirement Show. I'm your host, Rick Rivera. I want to thank everybody for tuning into today's podcast. And for today, what I'd like to do is I want to talk about mortgage rates. I want to talk about getting a mortgage, maybe using real estate as investments. And I brought on today with me Patrick Bova. And Patrick Bova is a mortgage broker, has been in the industry for many years. As a matter of fact, I have a little information here on Patrick Bova has been in the business for 35 years. He worked as a VP of sales for 9 years, owned his own wholesale lending company for 5 years, and owned his own retail mortgage loan and real estate company for the last 21 years. But bottom line, Patrick Bova is somebody that I've actually used personally over many years on my own personal transactions. So this Patrick Bova is not somebody that I just, again, pulled out of a hat. The people that we try to bring on the show are people that we actually use personally, we have a relationship with. It's just not some random individual. And not only has he dealt with me personally, he's dealt with my partners personally, and also our own clients. So I know he provides, excellent service. He's extremely knowledgeable. And the great thing about him is that he's honest, he's genuine, and this is not words. This is action that I'm talking about because there was a time, you've done, refi purchases for me, you've done refis for me, and there was some years ago, you're probably not going to remember this, but I had called you up and I was thinking about doing a refi. And you told me after looking at everything, you said, "Hey, Rick, you know what? You call me back. If I'm you, I'd wait at least 6 months before we, think about doing this." So you actually talked me out of doing it. Some, mortgage people, they're just looking to close deals, and not only did he do that for me, but he's actually done it with clients that I referred you to. So this is just not, I know for a fact this is his personality because I had clients, call him up and then they come back to me and say, "Hey, Rick, this is what Patrick told me. He told me hold off," or he told me, "Yeah, this is good or bad," or whatever. So he'll tell you exactly how it is. So he's always been a professional. And Patrick, I really appreciate you coming on the show today. And basically, the reason I wanted you on is because, whether it's, people sometimes will listen to our radio show on 590 and they'll give us a call and they have questions about mortgages, or maybe I'll meet people for the first time, or even our current clients, they'll have questions about mortgages and the current state of the economy and, should I be investing with interest rates being as high as they are right now, or should I be refinancing? And obviously, if somebody's got a low interest rate, they don't want to refinance, but maybe there's certain scenarios where would it make sense? Maybe they have credit card debt or whatever. But bottom line, I guess for somebody that's, is there anything you could tell us right now for those that are maybe thinking about purchasing property or scenarios where they're, thinking about refinancing, some things they should consider? What are some steps or things they should consider in a higher interest rate environment? I'm sure, historically, things are relative, so, what people are calling a high interest rate right now is probably, relatively speaking, not that bad of a deal. But maybe you can give us kind of like a state of the economy, so to speak, with mortgage rates, and where do you see rates going, a little bit on that topic.
Well, thanks for having me on the show. I appreciate it, Rick.
Yeah.
I've been doing this a long time, and the industry has run in different cycles, and I've seen pretty much every cycle for the last 35 years. Mm-hmm. The main issue, whenever you're wanting to purchase a home, especially in this climate, this market, the rates, the key factor is going to be, whether it's manageable for you, payment-wise, finding the correct investment, a good value on the property and so forth. Rates, in my opinion, they're going to fluctuate up and down, and they're really irrelevant at this point. Excuse me. The bottom line is you want to find a property, number one, that you can obviously get a good deal on, because properties, no matter what climate, they're one of the best investments you can do.
Right.
And rates, as long as we can qualify you, with the rates. And there's many, many different types of programs, whether we can qualify you via tax returns, income documentation, W-2 income pay stubs, or even bank statement programs and so forth. There's many, many different types of programs for people to qualify.
That's interesting that you say that, because I didn't mean to interrupt you, but like when you say there's many programs for people to qualify for, I know, we'll say like prior to '08, that big crash, I know there was tons of ways that people could do mortgages, all these, so is there, so maybe now people have a misconception that, hey, after all that had happened, new regulations, whatever, now we're only boxed into this, but you're saying that there's, I don't know, are things as loose as they were back then, or they're just, can you define that just a little bit compared prior to '08 to now as far as programs and things?
Yeah, I mean, a lot has changed since '08. A lot of federal regulations now has made it more difficult for most people to get financing. And it's definitely not as loose as it was back then. It's a lot more stringent. But with that being said, there are still many different types of products out there that we can qualify for. Obviously, the normal products are conventional, Fannie Mae and Freddie Mac type of products where you have to use income documentation, W-2 employees, tax returns. Even if you're self-employed, you'd have to use tax returns and qualify with that respect. With that being said, and then let me finish with my thought. The bank statement only program is another tool that we can use where you don't have to use tax returns, pay stubs. It's primarily designed for self-employed people. Gotcha. And so let's say the average self-employed business owner out there does not show enough income on their tax returns. They write everything off.
Right.
What we can do is use either personal business or business bank statements to qualify, 12 months business bank statements and so forth. And typically, you have to put a little bit more money down. You have to start theoretically at about 20% down. But we actually have programs that can even go to 90% with 10% down. We can do combination first and seconds, and we can do one loan. So, I mean, there's different types of products that we can use with that respect.
Yeah, no, that's actually good information because, again, there's so much misconception out there. People are like, hey, I know things are more stringent. They think, maybe things are hopeless for them. But when they actually can talk to somebody like you that been in the industry for a long time, knows everything backwards and forwards in this industry, they can at least get, sit down with somebody like you and find out for sure. Hey, is this really out of my reach? And maybe something here may be out of your reach, but maybe the nice thing about, working with you is you might be able to say, hey, here's what you can do that is within your reach. And then maybe you should start focusing your efforts and energy in this area where we can actually help you. Later on down the road, we can build this to get you ultimately over here.
Right.
So I guess, people shouldn't count themselves out. Especially, and again, it's all about getting, good advice from a professional. Yeah. And the reason why I have you on this show, and again, for those people that are just tuning in, is because I've been dealing with you for years, so I can vouch for the type of service and knowledge that you actually have.
Right.
Just like with our attorney, Joseph Hudak, I didn't just pick him out of a hat and said, oh, this is an attorney with a good bio, let me have him on the show to give some legal advice. Right. So I think that's fantastic. There's a scenario that I'm seeing lately, especially being in California. I have, there's a lot of retirees that are actually moving out of California, whether it's, their idea is to save taxes or they just don't like the environment or whatever the case may be. They're moving to other states. And a question that I get all the time, whether it be, again, people calling into the radio show, whether it's our own clients, and is, hey, listen, I want to buy a property in Florida or Tennessee or Texas or whatever it is, but I still got my property here. I identify a property in another state, but I can't afford both. I can't go and buy this one and still keep the mortgage up on this one and qualify for both mortgages. Do I have to sell my home here, have the cash ready to go, and then move out there and identify a property? Is there a way where if I see a good price or a good deal in another state while I still own my own place, be able to still qualify, get that place until I sell mine? And that's kind of a common thing that we're seeing a lot lately, because a lot of people are moving out of California.
Well, there's a lot of creative ways we can put that file together, even without using, what we call a non-QM loan, which is like a bank statement only program, which subsequently warrants higher rates and so forth. Mm-hmm. Believe it or not, under Fannie and Freddie Mac programs, which are your standard conventional best rates you can get available on the market, has programs and has guidelines that allows us to pull and set up distribution money. So let's say, for example, you've got somebody on a fixed income, mm-hmm. or let's say you got somebody who has a large retirement portfolio, either a 401k or an investment portfolio. We can actually set up a distribution. They don't even have to have a history of having money coming out of that fund. We can actually set it up from day one, and all we need is a letter from the money manager, such as yourself, stating that we have this account. It'll state it's either a 401k account or an investment account, and it'll show the account balance. We have to prove 36 months of distribution only with account balances, and we only need 1 month of distribution. So what I've been doing with a lot of your clients in the past, right, who are either on fixed incomes and so forth, what we've been doing is setting up a distribution, a monthly distribution for whatever amount of money we need to qualify them. So let's say they're on Social Security and pension, and they want to purchase a house outside of California. Let's use that analogy. What we could do is, without using the money from the sale of their house, if they've got a large enough distribution or a large enough account balance in their investment account, we can actually draw money from one account to help facilitate the purchase of the new house, and then set up a monthly distribution on one of the other accounts.
Right. And
that helps them qualify for both properties. Right. And you can answer this better than most. There's some restrictions to where if you put that 401k money back, you have it's my understanding you have a 60-day period.
Yeah, with IRAs, you can actually roll that back in.
You can actually, exactly. Yeah. So you can actually sell your home and then take the proceeds and put that money back into your account, right, without having any tax liability.
Right.
So, there's a lot of different creative ways to do that. With your analogy, that's something how I would put together.
Yeah, and I know for a fact, because we've done this before, mm-hmm, with clients, and there's probably people watching the show right now that are like, oh, wow, I never even thought about that. Yeah. So this, again, and I hate to sound like a broken record, this is where somebody can sit down with you and just see, hey, what are my options? Something that they thought was not even in the ballpark becomes now realistic and obtainable, because we don't want to miss opportunities. Again, you might you find a property that that you love, you like, is a great price, and now you're thinking, hey, this is gonna be a missed opportunity for me. When all of a sudden you talk to Patrick, and now he created the opportunity for you to get that property. So and there's different strategies I know that you have for that. Right. I had. Now here's another thing that I want to discuss is, and we'll talk more about the retirement planning scenario, is occasionally, you run into people and they'll say, hey, Rick, what do you think about reverse mortgages? What do you think about, I hear that, you're going to lose your home, or, you hear all these different, again, people getting, general information from who knows a buddy of theirs, the neighbor, the guy they work out with at the gym. So when it comes to reverse mortgages, retirement planning, do you see that as a viable tool? There's certain situations where it makes more sense than others, and what are some of the myths? I guess we know what some of the myths. Maybe you set the record straight on how they actually work. An actual reverse mortgage.
Well, the stigma we had in the past was, if I did a reverse mortgage and we pass away, mm-hmm, my property goes back to the lender.
Right.
It doesn't go to my beneficiaries. Well, that is false. That doesn't happen that way.
Right.
It's like any other type of loan that you put on your home. The difference is a reverse mortgage accumulates interest and accumulates the principal over time. Theoretically, you're using your equity to pay your mortgage for the next 15, 20 years of your life. Theoretically, you have to be 62 years old and above. And, the reverse mortgage theoretically has an accumulation of principal, and you're usually using the equity to extract money from your home or to cancel out your mortgage payments. It's not designed for everybody. Okay. Right. I'll give you a couple scenarios. If you've got one person, let's say, who's pretty wealthy, has a tremendous pension, Social Security and so forth, has their property free and clear, and has plenty of money coming in and plenty of money in the market. Would it make sense for them to do a reverse mortgage?
Yeah,
probably not. Yeah. Let's do the reverse. Let's say you have someone who's been retired for many years, who's on a limited pension and a limited Social Security income, has limited funds in the 401k remaining,
right,
and has a $300,000 mortgage. Okay. So basically, as a matter of fact, we have a few of your clients that we're already working with or have worked with in the past that had these similar situations.
Yes.
And so in that particular situation, doing a reverse mortgage benefit them dramatically because as the markets fluctuate, with the stock market and so forth, a lot of times as inflation increases and they're using more and more money each month, whether it's paying mortgage, whether it's living expenses and so forth, they're draining their 401k.
Yes.
And so in this type of situation, wiping out the $300,000 mortgage, not having a payment anymore, and then being able to have extra money in a credit line that's set up for you that increases every year if you never touch to extract money from your property as a credit line.
And I'm sure one of the questions they're going to ask is, how are they taxed on that money? Or are they taxed on that money that they receive from the reverse mortgage?
As far as federal tax or
yeah, would they pay federal taxes on that money?
No, it's just like a regular loan. Absolutely.
So there's no tax that they need to worry about.
No.
And in that example that you actually gave, it's actually a perfect example because I guess the scenario is you don't want to do it just to do it. So like in that first example, you say, hey, listen, the pensions are great, income's good, got plenty of investments for emergencies and everything else in the bank and everywhere else. By you taking out a reverse mortgage, it's not going to enhance your life. It's not going to bring anything to the table because you're already doing everything you want to do. You're comfortable.
Right.
But if you're in a situation where you're like, you know what, I'm retired now and I'm penny pinching every single month, and I feel like I'm living, paycheck to paycheck or Social Security check to Social Security check,
right,
and by doing a reverse mortgage frees up an extra couple of grand a month. All of a sudden, that could change your lifestyle. All of a sudden, now you're like, okay, maybe I can take a trip here and there and visit the grandkids a little bit more or whatever. That can actually change somebody's lifestyle. So if it's going to change your lifestyle, and but then what happens to? Because again, I know we're going to get this question. Let's say somebody gets a reverse mortgage. And they're getting the payment, everything's good, and down the road they pass away. They're going to say, well, does this now go to the bank? Do my kids get? How does that all work?
So there's a couple stipulations for reverse mortgages. Number one, you have to be an owner occupied. You have to continue to live in the property. So if for some reason that changes, whether it's you go into an assisted living home and you have to vacate your property, or you want to, or you pass away, and so forth, then the reverse mortgage has to be paid off at that point. And it's as simple as any other loan that we do. Let's say, let's use your example as far as they pass away. Now, if there's a spouse involved and one passes away, it still continues, and the other spouse can continue with the reverse mortgage until they pass away. Right. And if they pass away, then obviously, which I highly recommend, is having living trust. Mm-hmm. You should always, especially if you've got assets, you should always have a living trust and the property being a living trust. At that point, your beneficiaries can do one or two things. They can either come in refinance the property, pay off the reverse mortgage, and get a regular conventional FHA loan, whatever the case may be, or sell the property. And then once they sell the property, they pay out the reverse mortgage, and whatever's equity is left in the property will be theirs. It's just like any other type of loan. There's no difference.
Well, then let me ask you this, and again, we get hit with this all the time. Matter of fact, somebody called on our radio show the other day, and they said, "Well, what if?" Because we know that the interest is accumulating on the mortgage.
Right.
What if when they die, there's not enough equity in the home to pay off the mortgage? Can the reverse mortgage people come after their personal assets to cover that? So let's say the reverse mortgage grew to $500,000 and the home was only worth $400,000.
Right.
Are they going after the kids? That's a common question that we get.
No.
What happens with that shortfall, so to speak?
It's just like any other type of loan. Obviously if it's a standard reverse mortgage or a conventional loan, regardless of the situation, and the property is upside down, they have two choices. Or three choices theoretically. They can sell the property and do a short sale, and what that means is the bank or the lender who owns the loan will take less on the property or on their loan. They can do that, or they can actually do a deed in lieu of foreclosure and just give the property back to the lender, so on and so forth. It's just like any other type of loan. They do not have the rights to go back after, as far as I'm concerned. And this is something you may want to refer to a real estate attorney as well. I'm not an attorney, but it's just like any other type of loan. They would basically...
Well, because I understood, and correct me where I'm wrong, I understood that when you do the reverse mortgage, it's insured through FHA.
Correct.
So if the two, husband and wife, they pass away, and under that example where let's say the home is worth $400,000 and the mortgage is $500,000, it's a $100,000 shortfall. That FHA will go and make sure that the bank is whole. So the most that the bank can get is just the house.
Correct.
They can't come after their personal savings or go after the kids. And that's where the scary part comes in for some people is that, hey, can they come after all these other assets? So in reality, the only thing, and because again, I'm only asking because maybe laws have changed since the last time, we spoke or whatever, but if the house is upside down, both parents pass away with a reverse mortgage, the only thing that the bank is going to get is the home. They're not coming after the personal, because I thought that's what FHA did. Because I think part of the fee in a reverse mortgage, half is going to insurance to cover in case of a shortfall like that.
It's a mortgage insurance that FHA charges that insures up to a certain percentage of the house. It's like a regular conventional loan. So not a conventional, but an FHA loan. So let's say the bank will do up to 80%, and then FHA insures the remaining percentage of that if they go all the way to 96%, and so forth. It's the same thing applies for a reverse mortgage. They're insuring a percentage of that property. Now, I can tell you that when because doing a reverse mortgage is a calculation based on your age, based on the equity of the house. And so when these lenders calculate how much reverse mortgage they're going to give, how much a loan they're going to give, they're anticipating for the next 20, 25 years, theoretically up to age 99. Okay. So they're calculating based on normal history of appreciation, including the appreciation of principal balance and so forth. So 9 times out of 10, unless we have a market crash, that deflates the market substantially below normal history. Under normal circumstances, these reverse mortgages, rarely have that situation.
Yeah, their actuaries got these numbers pegged.
Absolutely.
They've been doing this for a long time.
They've been doing it for a long time, and they're not, and they know that that the interest is going to continue to accrue every year. So they have to base that on total appreciation and the equity position.
Gotcha. Yeah, and And I've seen scenarios where people have used them to offset like long-term care costs, things like that, medical costs, things like that. It actually, saved some people. So,
Yeah.
Again, new listeners listening to the show, if you're interested in that kind of information or like to get more detail regarding your personal scenario, if it would make sense, again, there's going to be links below on this podcast where you can click on and even get a hold of Patrick directly, and he can give you specific numbers on your scenario and even, advise you if it would even make sense for you to do it, whether it be now or down the road or whatever the case may be. And that's a great thing about dealing with you. Now, I had somebody give me a call. It was one of the clients. They knew you were coming on the podcast, and they said, I want you to ask Patrick this specific question for me. They're thinking about purchasing rental property as an investment, just using normal, money, not retirement dollars, just normal money. And they're saying, hey, is now a good time to do that, or should I wait till rates start to drop? So is with rates being where they're at, purchasing a rental property in this environment, good idea, bad idea? What's your thought process on that?
Well, I mean, I think that number one, if you can find a good property that not only is good value, okay, but also has good debt service, meaning that projected rents that are going to collect. Now, most people think because of high rates, it stops people from buying and so forth. Rates are, and I said this earlier in the podcast, rates are irrelevant at this point because the bottom line is, if the payments are manageable, or let's say in this situation, the payments can debt service, meaning that the rental can support the mortgage payment, then it makes sense to do it. You can always refinance the property down the line, 6 months down the line or more, when the rates do come down.
So let me just ask you this, because if, let's say they're going to buy a rental property and they have a principal residence, when they initially buy that rental property, do they have to qualify for both mortgages? Or are you saying that as long as the rent covers it, how does that work out? Or after a period of time?
Yeah.
Like how would that, as far as qualifying, how does that work out?
So normal guidelines state that if, number one, theoretically, putting 25% down is the key when you're buying rental property.
Okay.
Key on pricing and key on debt servicing and so forth. We can actually, along with the purchase price, or along with the purchase appraisal, the lenders are gonna require what they call a rental survey, and along with the appraisal, that's gonna tell us what the projected rents are going to be for that area.
Gotcha.
So what we do is either one or two things. If you've already got a renter going into the property and you got a lease agreement already signed, we'll use that lease agreement. And even if it's a projected rent, projected rents, and even if you've only gotten the deposit on it, we'll be able to use that to offset the mortgage payment.
Okay.
And to help you qualify for that.
Gotcha.
Now, what we do is we use 75% of the rent. So let's just say, for argument's sake, you got a $3,000 a month rent, and we can only use 75% of that, which is $2,300, something along those lines.
Right.
And let's say the mortgage payment is $3,000 a month, so you're going to run a $700 and some odd dollar negative. I'm just using numbers; these are not exact.
Sure.
So we'll use that $700 to add towards your debt ratio to help you qualify with your primary residence.
Gotcha.
And so forth. So ideally, when you are looking for rental properties, and here's the thing, where most people don't realize too is the rates are high right now. But guess what? So are rents. Rents are historically high. They're getting rents for three bedroom, 2-bath homes, 2,000 square foot homes. They're getting $3,500 to $4,000 a month in rent, which is unheard of just a few years ago.
Yeah.
And so forth. So it's in my opinion, it's kind of it kind of offsets the higher rates because you're getting higher rents as well.
Gotcha.
And here's the good news: the rents are going to sustain for the most part, but the rates could always come down. And we actually expect we're going into an election year, and the rates have already come down within the last few months. And we expect, and the Feds have even stated that the rates are projection to come down, this year.
Right.
And maybe even drop into the fives. Now, we don't have a crystal ball. We don't know where they're going to go.
Yeah.
But historically speaking, we're going to see the rates come down. It's a historical fact. I mean, if you watch the cycles over the last 30 years, you've seen the rates fluctuate up and down.
Gotcha. That's a lot of good information, Patrick. And once again, I'm going to emphasize to the audience that, if you're looking to buy what is rental, reverse mortgage, first-time home buyer, whatever the case may be, again, talk to someone like Patrick that's been in the industry for years. This is not his first rodeo. This way, he can let you know what is possible, what is not. There's programs out there that may be applicable to you that you're not even aware of. And it takes, it's a 15, 20-minute phone call, 30-minute phone call, and can make all the difference. So I want to thank everybody for tuning in. Now, if you'd like to get a hold of Patrick directly, once again, there will be links below where you can get a hold of Patrick directly, and he can give you information on your specific scenario. If you'd like to get a hold of us, obviously we specialize in retirement planning. And if you have questions about your retirement, your planning, your investments, feel free to give us a call, and we'll be happy to provide you with a consultation, and at no cost, no obligation. So with that being said, I want to thank everybody for tuning in. Again, I want to thank Patrick for all your help, not only today, but with our current clients, and appreciate, the years of, our relationship over the years. So thank you so much for coming in today, Patrick.
I really appreciate it. Thank you so much, Rick, for having me.
My pleasure. Thank you.
Falling for you.